Hi, I'm Brad Cornell, Emeritus Professor of Finance at the Anderson Graduate School of Management. And over the last several years, I've written numerous papers on ESG, a topic that has become very hot, both with regard to corporate decision making and investing. So, what I'd like to do today is take a broad look at ESG and evaluate for you what it implies both for how corporate decisions should be made, who should make key social decisions, and what are the implications for investors. So let's get started. I've taken the title ESG, Doing Good or Sounding Good, from a paper written by Professor Aswath Damodaran of NYU and me that used that title. And to give a precursor of where we're going to end up, Professor Damodaran and I concluded that there was a lot more sounding good than doing good. That much of ESG was hype that could not really be defended by hard data, and that some aspects of it may even be detrimental. So let's get underway. The first problem that concerned Professor Damodaran and me was that historically the G in ESG, by the way, ESG stands for environment, social, and governance, that the G, the governance, was the odd child out. Historically, the G issue has been about the separation of ownership and control. This began with the classic research by Burl and Means in 1930 and was followed up by a path-breaking paper by Jensen and Meckling in 1976. And both pointed to the same problem. That is that managers who run corporations will tend to maximize their own utility, not the wealth of investors. For example, a manager may choose to use corporate jets when regular public transportation would be more economical and in greater shareholder interest. That's just one small example. But E&S are very different. They aren't saying that managers have to be careful to maximize the value of their stock for shareholders. Instead, they're saying that companies should pursue environmental and social goals, even at the expense of shareholder wealth, that they have a broader duty to society. Now, I think you can see right away that a real issue arises only when management sets E&S objectives that do in fact reduce shareholder wealth. In fact, those instances may be quite rare if value maximization is understood properly. So what do we mean by value maximization? Well, the fundamental valuation equation, which is shown here as equation 1, states that the value of a share is the present value of the cash flows to that share, computed using the appropriate equity discount rate. So that's what, according to the standard finance model, managers are supposed to do. They're supposed to behave in a way so as to maximize the value of the shares for shareholders. And there's one thing I want to point out here that'll turn out to be very important. The rate at which shareholders discount those future cash flows, which is K, is also the rate they can expect to earn on their stock investment, assuming that equation 1 holds and the value of the stock equals the present value of future cash flows. Now, this may seem obvious, and to those of you who are finance students, well known, but it is immediately forgotten, even by leading market participants such as Jamie Dimon. For example, the fundamental valuation equation does not have a term. It gives value today there is no short-term value or long-term value, even though many corporate executives like to talk about maximizing long-term value. But if we go back to the previous equation, there's only one value, and it is long-term. It includes the present value of all future cash flows. So saying that investors are somehow too short-term oriented is equivalent to saying that their discount rate is too low. And empirically, this doesn't seem to make sense. We've just gone through a period of time during the pandemic where, if anything, the reverse was true. Take Tesla, for example. It has smaller profits than many automobile manufacturers and yet trades at a far greater multiple and has much more stock value. That's because investors seem to be looking long term. In fact, if there is a term problem, it is likely to be lucrative executive compensation packages tied to short-term metrics. But that's not a problem with the criterion of value maximization. That's a problem with executive compensation that leads executives not to attempt to maximize value. In other words, it's the traditional governance problem. Now, I bring all this up about short-termism because short-termism is often tied to ESG via the argument that environmental and social policies have long-term benefits but short-term costs, and therefore are not properly valued by the market. That does not give sufficient credence to the long-term benefits. Now, when you think about it in terms of equation one, this is not really a criticism of value maximization, only that it is not being properly applied. If bad social and environmental policies have long-run value-reducing impacts, proper value maximization will take account of that and therefore be consistent with E&S. One way to think more clearly about ESG is to do a simple thought experiment. So I want you to imagine a food delivery company like DoorDash, and they have one decision to make. Do they use electric vehicles or gas-powered vehicles to deliver the food? And which choice is more consistent with ESG? And we're going to consider three scenarios. The first scenario is that the electric vehicles are cheaper. And we're assuming here the company has a way to measure the all-in costs of the two types of vehicles and make an apples-to-apples comparison. So if the electric vehicles are cheaper, then both maximizing shareholder wealth and taking account of the environment both say use the electric vehicles. Now, the second one's a little trickier. The government has instituted a carbon tax. And this carbon tax has been set so that if you use the gas vehicles which lead to emissions, the tax exactly equals the social cost of emissions. So this means that the gas vehicles are on an equal footing now. They don't have the benefit of emitting CO2 and not paying for it. But even so, even with the tax, the gas vehicles are cheaper. Well, if the gas vehicles are cheaper, maximizing shareholder wealth says use the gas vehicles. But what about ESG? Most of my students tend to say, well, ESG says use the electric vehicles because of the environmental benefit. But that's a very limited view of E&S. Remember, there's a social element too. And the company delivers food, and it has to charge for that. If it uses more expensive vehicles, there's going to be a higher charge. That's going to be a social detriment to all the people who have the food delivered to them. The company may also, if it uses the more expensive vehicles, have to lay off some people. That would hurt employment. And finally, if it uses the more expensive vehicles, it's going to hurt shareholders because the profits will be less. And if you tally the whole thing up properly, the S part outweighs the E, and you should use the gas vehicles from an ESG point of view. And the reason is the benefits are larger than the costs associated with the tax, which mirrors the social costs. Now, if you want to think real clearly about an example of this, think of airlines. Airlines are one of the most profligate users of fossil fuels and creators of emissions. But they also provide huge social benefits in terms of rapid movement of people and goods. And that social benefit is even larger. So in S2, where the emissions are properly priced, if the gas vehicles are cheaper, they're the ESG solution. Where the rubber really meets the road is where there is no pricing of the carbon emission, and the gas vehicles are cheaper. This is the difficult situation. The government has failed to properly price emissions, so if the company uses the cheaper vehicles, it will maximize shareholder wealth, but at the expense of global warming and added CO2 emissions. So in this situation, is the company obligated to somehow weigh the social benefit provided by the electric vehicles? And if they are supposed to weigh it, how much? These are very difficult questions. The thought experiment highlights a particularly critical issue. Every society faces E&S problems. Climate change, racial equality, whatever. The question that the thought experiment raises is how should those issues be addressed? In particular, what role should corporate executives play? And this is not a new issue. As far back as 1970, in his famous New York Times article, Milton Friedman addressed exactly this issue. And though many say, well, that was more than 50 years ago, what relevance does it have today? I think if you go back and read Professor Friedman, it is absolutely relevant today. He identified two particularly critical issues. So let's go back and see what he said. The first issue is what he calls the standing issue. What standing do corporate executives have to play? What have in the making of critical social decisions? And I urge you to pause the video, maybe read the entire thing, but I've highlighted some key passages. Friedman says, on the level of political principle, the imposition of taxes and the expenditure of tax proceeds are governmental functions. Here, the businessman, self-selected or appointed directly or indirectly by stockholders, is to be simultaneously legislator, executive, and jurist. And he goes on to say, this justification disappears when the corporate executive imposes taxes and spends the proceeds for social purposes. He becomes, in effect, a public employee, a civil servant, even though he remains in name an employee of private enterprise. He concludes, if they, being any agents, are to impose taxes and make expenditures to foster social objectives, then the political machinery must be set up to guide the assessment of taxes and to determine through a political process the objectives to be served. In other words, executives do not have the proper standing to be making social and environmental decisions. And it gets worse. In our current financial markets, a limited number of firms such as State Street, BlackRock, and Vanguard have amassed immense voting power because they hold so many shares through mutual and exchange-traded funds. The problem is that a cornerstone of our democracy is that key issues such as environmental and social policy are decided by representatives elected based on one person, one vote. If decision-making is transferred to corporate directors who are elected on the basis of one share, one vote, then wealth becomes a key factor in determining critical public policy regarding the environment and social issues. And that, in a nutshell, is Friedman's standing problem squared. And I find it, quite frankly, very convincing. Now, there's one more issue that Professor Friedman referred to, and that is what is called the information issue. Let's put aside for a moment the standing issue and suppose that the corporate executive can get away with spending stockholders or customers or employees' money on environmental and social projects that he or she thinks are appropriate. But how does he know how to spend it? Take Bob Iger, for example, who's just been reappointed as CEO of Disney. He's presumably an expert in running an entertainment company, in how to produce product and finance it and sell it. But that doesn't make him an expert on nuclear power or social engineering, or whether we ought to try to avert climate change or accept it and adapt to it. All these are immensely complicated issues, and ones that virtually all corporate executives are not in a position to deal with. And they shouldn't be. They should be running their company well. That's the way they produce social value, not attempting to solve environmental or public policy issues related to social needs. So, in my view, and we'll come back to this at the end, Friedman has hit on the two key points. And I quite frankly am persuaded by his conclusion, which is that corporate executives ought to run their business as well as they can, create as much value as they can for shareholders, subject to the rules of the game that will be set by officials elected on the basis of one person, one vote. We'll go back to Professor Friedman later. His points are just too important to ignore, and we'll conclude with them. But for now, let's turn to investors. When it comes to investors, Professor Demoterin and I asked, can they have their cake and eat it too? Can they invest in what they think are green companies and feel good about themselves, and simultaneously earn higher rates of return? Many pundits have said so. Unfortunately, they're wrong. So to see why, let's go back to that fundamental valuation equation that we introduced earlier when we were talking about shareholder value maximization. And that's this. The price of a share equals the present value of the future expected cash flows to equity, discounted at the appropriate equity discount rate, K. And K is going to play a really central role here because K is the return that investors expect from the stock. But there's a trick, and this trick has confused a lot of people, and it's worth explaining in a little detail. So what we're asking about now is if investors have preferences for green stocks, if they want to hold a wind farm company and not a fossil fuel company, then how does that play out in terms of stock returns? Can they have their cake and eat it too? And this graph shows what happens. So in the first phase, people are clueless. They don't know the difference. This is prior to global warming concerns. People don't know the difference between green and brown stocks. So both have the same expected return and both move together. Then in the second period, people wake up. They say, geez, we have a crisis here. It's called climate change. We've got to do something about it. I want to feel good about myself. I want to hold green stocks. And they're willing to hold green stocks at a lower expected rate of return K because they want to be involved with the green companies. So what's that do? What happens if K falls? Well, if K falls from equation 1, P rises. And P rises means you're getting a better return. That's what happens during the wake-up period. The green stock rises because K falls, and the brown stock here shown in red, the green price rises because K falls, and the brown stock that people don't want to hold, they demand higher pecuniary returns to hold this bad stuff. K rises and P falls. But that's only during the adjustment period. Once the adjustment is over, once K has fallen for the green stocks and risen for the brown stocks, from then on in the final period where prices fully incorporate investor preferences, the brown stock is going to earn a higher return. So you cannot have your cake and eat it too. If you prefer green stocks, and most investors apparently do, and you're willing to accept a lower rate of return thereby, you're going to get a lower rate of return. That's pecuniary return. You may feel good about yourself. You may get a non-pecuniary return. But in terms of dollar returns, finance theory predicts that the brown stocks are going to earn higher returns than the green stocks. Now, that doesn't mean that the green stocks won't be providing a greater social value. If investors are willing to accept a lower rate of return on green stocks, that translates into a lower cost of capital for green companies, and that provides an incentive for green companies to undertake more investments than brown companies. So there is a social benefit. You can have the cake, but you can't eat it too in terms of higher expected returns. Now, the reason this gets confused are these final two stages. During the adjustment, when people are waking up, yes, you can have your cake and eat it too. Investing in green stocks while there's a transition going on will earn higher rates of return. But it's only true for the transition. After that, in the long run, the returns will be less. And that's the explanation for this type of confusion. Here's one big article saying ESG index funds are outperforming mostly. That probably was based on a study done early on during the transition period. Here's a comparative one. New PRI study finds ESG funds underperform broader investment funds over the long term, as they should. So when you're talking about investment performance, you have to be very clear what historical period of time you're looking at. Because during the transition period, green stocks will outperform, but in the long run, they will underperform. So there's good news and bad news here. Investor preferences for green stocks will help green companies make investment and combat climate change, but they will do so at the expense of offering lower expected returns for those investors. So far, we've been talking as if you could tell green companies and brown companies apart, but that's not so easy. Consider an example. Consider Tesla in China. Is Tesla a greener company in China than Toyota? Well, you'd say, certainly. Tesla makes all electric cars, and Toyota makes almost exclusively internal combustion engine cars. So clearly, Tesla's greener, but not so fast. To build a electric car, you need batteries. And the batteries are a very energy-intensive production process. And in China, the production of those batteries requires electricity. And that electricity is provided from a grid that relies on the 60% coal for generation. So the making of the cars is much browner for Tesla than it is for Toyota. Well, what about the driving? Well, the driving requires charging the cars. Once again, 60% of that electricity used to charge the cars is going to come from coal. Coal is sufficiently dirty that it leads to more emissions than running an internal combustion engine automobile. So on both counts, construction and operation, right now Tesla is the brown and Toyota is the green. But cars last a long time. They don't last 1 year, they may last 10 or more. As time passes and China's grid becomes greener, there may be a crossing point at which Tesla becomes the green car, the green company, and Toyota becomes the brown one. But who knows where that is? That depends on Chinese policy. And there's nothing unique about this example. We people like to rank things. We rank things when it makes sense. Here's a ranking of the tallest mountains in the world. It's pretty hard to disagree with this list. We can measure mountains very precisely. But what about the best place to retire? American financial publications like to advise on that. And here are what 3 said. This is Forbes, Add U.S. News and World Report, and Add Kiplinger. Now, if you look at and compare these 3 reports on the best places to retire, you'll see that there is no overlap at all. Not one city appears on all 3 lists. When you think about it, that's not so surprising. There isn't a, quote, best place to retire. If you like golf, it might be on a golf course in Phoenix. If you like skiing and hiking, it might be in Park City, Utah. If you like theater and opera, it might be New York City. So the best place to retire clearly depends on people's preferences. And quite frankly, it's my view that ESG is pretty much the same. If you're particularly concerned about race relations, then that's going to be part of ESG. Economic equality, that could be. Climate change, maybe. The future of nuclear power, maybe. The problem is that there is no clear ESG. It depends on who you're talking to and what they want. And that's not only true for situations within individual companies, but it's also true across countries. Jason Su and I wrote a paper comparing ESG in the United States and China. And it came to several conclusions. In China, there's no dispute that the power to determine E&S policy lies with the government, not companies. So the Chinese are on the same page as Milton Friedman there. But in setting E, China puts much more weight on growth and development than in the West. You can see this in Xi's recent speech, stressing the importance of growth and development, even at the expense of climate change. In setting S, issues like gender and race are downplayed in China compared to income distribution. In short, there is no ESG policy, either within a country or particularly across companies. It depends on the facts and circumstances in each country and the preferences of each investor. So we've covered a lot of ground. And what can we take away from all this? This is my opinion, and admittedly, it's an opinion. First, every society must address E&S issues. The question before us is what decision-making authority with respect to E&S should rest with business executives and institutional investors. Quite frankly, I am persuaded by Milton Friedman's view, the answer is very little. It is fundamental to American democracy that E&S decisions be made by public officials and the experts they appoint, elected based on the one person, one vote standard. Attempting to allocate that decision-making authority to executives runs afoul of both problems that Friedman stressed. The first being standing, that executives elected by shareholders, appointed by boards elected by shareholders, don't have the standing to make public policy decisions. But even if they did, in almost no circumstances would they have the appropriate information. Making a decision about whether or not we want to engage in solar geoengineering is not something I want left to the view of an entertainment company executive. I want that to rest with the Department of Energy appointed by an elected president. So where do I come down? Admittedly, politics is messy, particularly now. But that is a reason to improve our politics, not to transfer critical public decisions to private parties. Instead, the public officials, as Milton Friedman said more than 50 years ago, have to make the rules. And then given those rules, business executives have to operate within them to maximize the value of their shareholders' holdings. So when it comes to ESG doing good or sounding good, much more of it is sounding good than doing good, in the opinion of both me and Professor Demoterin. Thanks for listening, and I hope you weigh these thoughts when you reach your own conclusions. Bye-bye.